of Supply Chain and Business Technology Management at Concordia University, and I'm also a practitioner, so I actually work in the field of supply chain, but I actually do it on a full-time basis, working for several consulting firms at different client side. So today I'm going to be talking a little bit about supply chain, and basically what I'll be talking about is a new and innovative practice to be able to mitigate or reduce the risk in the supply chain. And the reason why I mentioned that it's actually an innovative approach is simply because there are some classical management approaches that you can use, which I'll talk about in the next few minutes. And there's also some mathematical equations that you can use to be able to quantify risk and to be able to mitigate it. So what I'm proposing today in this study is that I'm going to be providing a combination of 3 different methods that are going to be used simultaneously to reduce supply chain risk. So I'll be talking a little bit about classic management practices. I'll be talking about a mathematical equation, which is the Black-Scholes-Merton model, which was developed by a professor at the Massachusetts Institute of Technology. And I'll also be combining something new, which is the service-oriented architecture and using web services. So these are the 3 approaches that I'll be combining in order to present a new and efficient way of identifying and mitigating supply chain risks. So what I'm proposing over the next 15 minutes is I'm going to talk to you very quickly about the motivation or the current challenge that we see in the typical companies, whether it's the government or just private or public companies. So what is the challenge in identifying and mitigating supply chain risks? I'll be talking about the research that I've done so far, which has helped me to gather some materials and to test a specific methodology to see if it actually does work as a prototype. And then I'll be doing a deep dive because that's the new innovative approach that I'm actually proposing, which is web services and service-oriented architecture. And then I'll be talking very briefly about the quantitative model or the mathematical equation that I'm proposing to modify and to implement in order to calculate risk in an organization. Okay, so basically, the best way I can describe how supply chain risk is generated is by talking about 2 of the recent trends that we've noticed in the industry over the last 2 decades. The first one is companies are increasingly forming global supply chains and favoring global sourcing practices to lower purchase price. So what does that mean? It means that a lot of companies are actually starting to expand abroad, and as a result of that, they can no longer use the current suppliers that they have locally, and in fact what they need to do is that they need to go out to international markets and to be able to identify suppliers in the international markets that could provide them with the raw materials or the services that they need in order for them to output the product or service that they offer to the clients globally. So what does that mean? The first implication that I think of is the fact that we're actually increasing our supplier base. So that would be the first driver. The second driver is basically trends in M&As or mergers and acquisitions and general industry consolidation. So what happens is that a merger and acquisition is where a company identifies another company and they decide to merge, or simply one buys another company. So there's several reasons why a company would want to merge or acquire another company. The first one is basically there's going to be some synergies that you can generate through that. So for example, I have a product line but I don't have a market. So by buying a company that has a market, I can provide my products to that new market. And the second opportunity is I have a product line, and by joining with another company that has a complementary product line, I can now offer this new product line to my existing market. So that's what I call synergies. But today, I'm not trying to focus on synergies, I'm actually trying to focus on redundancies. So when I talk about redundancies, before a merger and acquisition actually happens, you have 2 different entities that are operating using different systems, different processes, and different people. So when you combine these 2 companies, you just created a redundancy. And the specific redundancy that I'm looking at is basically the supplier base once again, so the number of suppliers. So for example, if a company was dealing with 8,000 to 10,000 suppliers and they go ahead and acquire another company, there's definitely going to be some overlap, meaning that they may be using certain same or identical suppliers like IBM, Microsoft for software, but in some cases they'll be using a different set of suppliers. So by combining the 2, you're once again increasing your supplier base. So I just gave 2 examples on how we're increasing the supplier base, and now I'd like to talk to you a little bit about the impact. So the impact is nothing more than just a positive correlation between the increased number of suppliers and the increased number of risks that you have in your supply chain. So what that means is that the more you increase your supplier base, the more it becomes complex to manage, the more it becomes expensive to manage, and the more you're increasing your risk because you're increasing exponentially the number of transactions that you're doing with different suppliers, and as such, you're increasing the risk. So what my study is looking to do is it's actually looking to identify and mitigate that risk. So when I was talking earlier about the classical approaches that we have in management to be able to reduce risk, some of you may be familiar with some of them. Like for example, if we look at supplier relationship management, it's basically a management process that we put in place to measure the performance of specific suppliers. We also have a vendor management office where we're actually going to look at contract compliance. For example, is the supplier delivering the right product at the right quality that we agreed in the contract, and is he respecting the prices that we agreed upon? So these are all very interesting management approaches that you can use, but let's think about it for a second. When two companies merge and we're dealing with thousands and thousands of suppliers, you have a limited number of resources in procurement and supply chain that can actually look at all of these things. So that's when the model can actually become a very interesting option, because what it's doing is that it's actually going to be evaluating potential risk real time and doing it for thousands and thousands of suppliers by the second. And I'm going to be elaborating on that in just a few minutes. But before I do, for some of you, the concept of supply chain is basically a combination of 5 nodes or 5 specific activities that a company does. The first one is everything that has to do with planning and forecasting. The second one has to do with sourcing and procurement. The third one is production and operations. The fourth one is distribution and logistics. And the fifth one is basically reverse logistics or returns management. So in a supply chain, when it's defined, and as the Massachusetts Institute of Technology defines supply chain, it's basically the flow of goods, information, and money across the supply chain. What I'm focusing on in this specific study is the movement of money in the supply chain. So what I'm looking to do is that there's a lot of, it's actually an emerging trend in the industry. A lot of companies are actually starting to focus in on the actual monetary activities within the supply chain, and there's several reasons why they want to do that. The first one is that they want to improve their cash flow. And I'm not going to go through all of them, but I'll just give you a quick example. Improving the cash flow has to do with the amount of time or reducing the cycle time between the moment that you invest your money to get raw materials and resources to actually produce a good, ship it to the customer, and collect the money in return. So a lot of companies, the faster they can execute within their supply chain, the faster they're able to regenerate the money into the company for reinvestments. And then there's other advantages of optimizing the supply chain in terms of a financial perspective, like for example, managing risk, optimizing tax effectiveness, especially if you're going to be going global, and then finally monitoring and improving key performance ratios. Okay, so the research, the materials, and the methodology. So basically what I'm proposing is I'm proposing 2 things. The first one is an architecture to evaluate the risk of suppliers by evaluating the probability of bankruptcy. And the way I'm proposing to do it is by developing a web service. So a web service is basically a piece of code that is developed in PHP. And what it does is that it actually connects to the New York Stock Exchange to be able to download information from public companies. And by using that information, it's able to generate that or export it into a mathematical equation that will actually compute the risk, and that gives you flags for companies that have higher risks than others. So what I'm using is basically a sample of companies from the New York Stock Exchange. I'm using information from the database on computing, or actually Center for Research and Security Prices. And basically what I've done is that I picked 100 companies, separated in the 4 sectors that we see below, and basically I'm going ahead and computing the risk. So when I was talking about web services, just to make a very clear distinction, is that it's a common language that can operate between all the different entities. So if you have an environment that operates on a different infrastructure and different hardware, no matter what infrastructure or hardware you're using, it can communicate with another company to get that information using web services. So what is a service-oriented architecture? Well, basically the benefits of a service-oriented architecture is an architecture that allows you to develop a specific service. And in my case, I'm developing a web service, which is using the BSM model or Black-Scholes-Merton model. And basically, what's interesting about this model is that you can adapt it or you can tie it into an SAP or any other enterprise resource planning software. So companies that are implementing SAP, as soon as this model is developed, you can just plug it in, and that plugin is able to go on the stock exchange, get the information, compute the risk, and provide the company with specific indicators so that they can measure risky suppliers and manage them accordingly. Okay, so now just to talk to you a little bit about the equational model. So basically what we see over here is a series of 4 formulas, okay? What's interesting about these formulas here is that there are 4 non-linear formulas that are being computed simultaneously. Okay, so unlike a typical mathematical problem where you take a specific formula, you solve for a certain value, and whatever value that gives you, you plug it onto the master formula and you get the balance of the value. In this particular case, you're actually solving 4 nonlinear equations simultaneously. So how does it work? Well, basically, I'm not going to go through the details of the formula, but what we're trying to do is we're trying to calculate, just like in accounting, equity is equal to the value of your assets minus your liability, and liability could be a debt. So basically what you see in this formula is that you have the standard cumulative normal D1 and D2, which are being computed using the formula over here. And basically, as these formulas compute, it's able to generate the specific risk level for a company. And basically what you're looking at is N minus D2. This is the number that will actually give you a risk in percentage points. Okay, so the limitations with this study right here is that I've talked so far about public companies where they actually provide financial reports on the web. It's available for everyone. But the question then becomes, well, what do you do with the private companies? How do you measure risk for private companies? So that's something that I definitely addressed, but not using this particular model. There's other models that exist to be able to address risk. They're also mathematical, but it's not necessarily the Black-Scholes-Merton model. Like for example, there's a Z-score approach, which was developed by Professor out in New York University, where he's basically taking 5 financial ratios, and by combining the 5 of them, he's able to identify what the risk probabilities are. What's interesting about that is that as soon as a company could give you audited financial statements, you could just take those numbers, plug them into the formula, and it gives you a certain level of risk. So what I'm saying here is that there's different approaches in measuring risk. They all have their pluses and minuses. And the purpose of my study is to do 2 things. First of all, to try and develop a hybrid model where I would use a specific weighted average on these 3 methods, and the weighted average would depend, it would be influenced by the sector that the company is in, or, for example, the industry itself. Is it a volatile industry, or is it a strong and solid industry? So, in conclusion, the study clearly shows the usefulness of estimating the probability of supplier bankruptcy. So I plugged it into the model, I generated results, and I was able to calculate risk for some of the public companies. The second point is the proposed model can effectively and efficiently identify risks of bankruptcy in a corporate setting. So the reason why I say effectively is because there's no mistakes, simply because you're not using a subjective approach in identifying risk. You're actually plugging it into a mathematical formula. And the reason why I say efficiently is because, as we know in the stock market, the stock prices change every 15 seconds. So if you're going to be measuring the risk of thousands and thousands of suppliers, and you know that the stock prices change every 15 seconds, then what else can you use but a web service that's directly connected to the New York Stock Exchange, and that is able to generate every 15 seconds the new stock price changes, and that is able to crunch it into the formula and generate the risk in real time. So that's the benefit of this model. And then finally, the model can act as a decision tool in effectively reducing the risk and overall supply chain risk. So when I say can act as a decision tool, the reason why I mention this is because it shouldn't be the only indicator that you use when you measure risk. It should be used with other classical management approaches and other type of risk models to make sure that you're looking at it at a risk level from a holistic standpoint. So that basically concludes my presentation. Any questions? No? Thank you.